Hi, Dominique, and welcome again to another week of the week ahead. So maybe we'll kick off as we normally do on kind of your thoughts on what's transpired, I guess, over the last week and the kind of the market's interpretation of it.
Well, the market doesn't want to let go of Goldilocks, and I feel a bit like Cassandra in there. The data, retail sales in particular, show that growth is actually quite robust. I think it's already rebounding. The market, the Fed keeps saying that cuts next year, not likely to happen. And the market would like to ignore the Fed. So we still have rate cuts priced next year. At the same time, we had both an increase in 2 years and 5 years yield, which I think reflects the fact that actually the market agrees with me. The Fed is not doing enough to contain inflation, even if there are no cuts next year. So basically, the market thinks the Fed doesn't have the guts to do what it takes to bring down inflation, i.e. a nasty recession.
Right. So this week, I guess, is coming out of Jackson Hole. Yes. So
the J meeting.
Yeah. So this has been like the big event. I'm going to say fixed income and probably even equity bears have been waiting for weeks now. How would you? Yeah. What do you expect to come out of this?
Well,
and how do you think the market will interpret it?
I'm glad I'm not Jay Powell, because last year he made some very optimistic comments about, inflation is transitory, labor market tightness is overstated, and he's being taken to task on those comments, which I think is a bit unfair because it reflected the established wisdom at the time and the information available at the time. For instance, there was no recovery in participation at the time of the last Jackson Hole conference, so it was fair to say that, the unemployment rate was overstated, labor market tightness. So poor Mr. Powell, he's in a bind. He knows that his models are probably flawed. They are not giving him any signposts. So what is he going to do? He's going to hedge or fudge, if you prefer. He's going to, first of all, say that he's like 150% dedicated to bringing inflation under control. He loves Paul Volcker, his hero since he was a child. I'm joking, but he's going to tell us that, he'll be there for us. At the same time, since he doesn't really know what is happening, and remember, the minutes we got were the minutes of a meeting that took place after an extraordinarily strong, before an extraordinarily strong NFP meeting. So, when you don't know what is going on, typically what you do is you stick to existing plans. So he's going to basically repeat what's in the SCP and be the proverbially two-handed economist. So on the one hand, if the data comes in less strong than we expect, maybe since we are neutral, we can afford to go slower. If the data comes out stronger, we will go faster. Some fudge along these lines. But I don't think he's going to give us much resolution on what, in my view, is now the most important issue. How much inflation is the Fed prepared to tolerate? Because my 8% forecast is, of course, predicated on the idea that the Fed stick to its 2% inflation mandate. And since the Fed knows, as well as we do, that the more you wait and the more you fall behind the curve, the more painful the recession is. I mean, that's the story of the early 1980s.
Right.
So the alternative to that is to let inflation not quite 6 or 7%, but maybe around 4%, which, by the way, doesn't work, because when inflation gets that high, behaviors change. And if you have another shock, say Putin decides to cut off all supply, or say cut half of his oil supply to global markets, the impact of that is much stronger. The impact on inflation is much stronger when inflation is high than when inflation is low. So typically, countries that have had inflation around, say, 4 or 5%, either have come down to 2% or have moved on to double-digit inflation. But that takes a number of years. So I don't think we're going to get much resolution. And also, Chair Powell has a not easy task ahead of him, but he doesn't have to do a Q&A, a live Q&A, as he does after his, at his press
Normal kind of,
after the FOMC meeting. So basically, he can tell us whatever he wants, and there won't be a direct challenge, at least not right away.
Right. Traditionally, I haven't looked, so traditionally, is this a big market moving event or not?
Yes.
Yeah.
It is, because traditionally big policy moves like new rounds of QE were announced at Jackson Hole. But given the bind the Fed is in at the moment, I think we just have to get more inflation data, which unfortunately is very slow. It's one print a month, to get a sense of how bad things are. In my view, they are quite bad. And also start to get a hint of, is Fed chair Paul Volcker or Arthur Burns. And I still give him the benefit of the doubt. I think he'll prove to be a Volcker, but this is an issue clients are raising, and I think it's a very, very legitimate and important question to raise.
What about, so he's not really going to say anything that's going to massively change. I can't see what he changed. I mean, he can signal 75, and that's kind of debatable, and he can say, I don't expect cuts immediately. It's going to have to be held longer than that. But he's already said that. Kind of. So what about QT? Could that be a drastic new? And I know a lot of times that they've announced kind of new initiatives or something. Yeah.
So QT, the problem is that he has a member on his committee who is very worried that QT could break down US markets. And that's President George from the Kansas City Fed. So it's hard to do something drastic on QT without more of a consensus. And he also has quite a few, he's brought in some serious doves. Professor Cook, she's a Black Lives Matter activist. In the minutes, there was a dovishness that wasn't there before, which of course happened before the NFP. So I think he needs more data to do anything with QT. And then with QT, there is a constraint we discussed before, that if he really wants to speed up things, he has to sell his MBS and to a lesser extent his bonds. But his MBS, there's only 2 billion that matures now between now and the next 5 years. And if he sells, he's going to make capital losses that will wipe out the Fed equity, because QE is a basically buy high, sell low bond investment scheme, and Congress will be after him. So he's in a tight spot because—
Is it more likely he would wait till after the midterms then? I guess, or it doesn't matter that much?
I don't think it matters that much. And I think in a way we want to know, because the data after we will have what? The midterms are in November, so we'll have 2-3 more data points. And that's probably what we need to get a strong indication of where things are going. So maybe that's one of his few blessings, that in order to get the data he needs to decide on policy direction, he'll have to wait after the midterm.
Yeah. Okay. Okay. So we don't see a massive market moving event unless somehow the market had anticipated. I guess the market's anticipating he's going to be more hawkish. I mean, that's kind of, and if he's not more hawkish for some of the reasons that you brought up, don't know, we can continue this, whatever we call it, bear market rally, relief rally, or repositioning. What anything else for next week in particular? I know obviously this is going to be the dominant factor, but and are there other Fed speakers that speak during the
Yeah.
Jackson Holes, or just him?
I mean, so Kashkari is speaking early in the week, but it's really, I mean, the limelight is going to be on Powell, and you know, in terms of surprises, he is at a juncture where he needs more information. He doesn't have a model that allows him to navigate ambiguous data as we are getting now. So it's not like we are at a juncture where a policy decision needs to be taken. And in terms of more of the same, you know, I suspect the market might have a different definition of hawkish from yours and mine, because whenever Chair Powell, you know, just keeps repeating the script that is in the June SCP, the market calls that hawkish. To me, it's not hawkish. It's more of the continuation of the wishy-washy policy discourse we've had for the past few months. So perhaps him confirming that, you know, he's behind the few FOMC speakers we've had over the past few weeks, that, you know, cuts next year are very unlikely. Perhaps that's enough for the markets
Right.
to think that the Fed is hawkish.
So, okay.
Yeah.
Any big data, anything besides that next week?
Yeah, I mean, we get the end of month data with PC, and PC, again, it's not the level that counts, but the structure. Are we seeing a stabilization of the decline in goods price inflation and an acceleration in services price inflation? That's what I will be looking for. I think on personal consumption, the market is too pessimistic. I mean, we've had really good retail sales, especially considering that households are cutting down on non-durable. And, you know, we have this backdrop of falling savings rates. I'm expecting a positive surprise on consumption. But to be honest, I mean, the really important story is Jackson Hole, and I'll be, of course, commenting about it on real time.
Okay. Well, as always, you know, clients can, so we always say, reach out to us, you know, ask questions, any feedback on the Bloomberg chats, emails, Slack room. And yeah, we're here, and, you know, good luck everyone, and have a great rest of the weekend.
Yeah, good luck. Enjoy your last week of summer.
Okay.
Bye.
Bye.